without any further ado, we're going to hit you hard early with Martin Weitzman here. And I'll leave introducing Martin to Kirk. But this, as I said, is an area where the theory really is very important to both getting our ideas fixed, getting them straight, but also we're not going to succeed in changing the public discourse if we're not building these measures and metrics on firm foundations. So we are starting, as we should, with the theory, and I'll hand over to Kirk to introduce Marty.
Thanks, Cameron. Do we know how PowerPoints are going to work? There's some last-minute organizational things that we haven't discussed. I know Marty, I think, brought some. Okay, it is working. Excellent, okay. With that out of the way, Marty Weitzman, to those of us who know him, Martin Weitzman otherwise, professor of economics at Harvard University, previously with MIT and Yale, widely published in the very top economic journals, author of 3 books. He is focusing currently on environmental economics issues, especially climate change, economics of disasters. I have to mention one paper because it's so important. On the welfare significance of national product in a dynamic economy, Weitzman, 1976. When I was a struggling assistant director of national accounts in Canada, starting work on greening the national accounts, it was hard to think clearly about what do we add and what do we subtract? How do we do these things in a national accounting framework? And when I read that article, it suddenly became clear. Suddenly we understood there is a framework for understanding this. In growth theory in the end. And that has engendered a huge literature since then. It's one of those papers that really has started the ball rolling. So with that, please, Marty, please come up.
Thank you for the kind introduction, Kirk. It's a pleasure to be here. I'm going to move rapidly because I haven't got a lot of time. So if I had to summarize anew what it is that I'm presenting, what this is about, it's a big fat target for further developments, complaints, extensions, whatever. So I'm going to lay out sort of the core theory, the strongest imaginable quantitative relationships among the 4 fundamental economic concepts: wealth, income, sustainability, and accounting, or complete accounting. Again, the point of departure is the simplest case, and it's the core theory, I would say, revisited after, 30 years. This model is going to give very strong results, but it's so simple that it's applicable only at very high levels of abstraction. So there's been many generalizations. Typically, the generalizations will get more, will cover more ground, but what they give up is some analytical nicety or some of the tightness that's there in the original theory. All the models in this area, I have to emphasize, all of them make strong assumptions to get strong quantitative results. They all need to have something like accounting be complete, or what would happen if accounting were complete. None of them can get anywhere without that assumption or something close to it that will replace it. Okay, so let me go quickly through my framework. Look, here's how, there's an economy out there, a convex economy with laws of motion, including that net investment equals the change in capital stock. And the way I'm going to close this model right from the beginning is to say that is that the rate of return on consumption is some given constant. R. And that does not seem to me to be the worst way to close a model, because the rate of return has been kind of trendless over long periods of time. Sometimes it goes down, sometimes it goes up, but I think we can call it trendless over the century. So there's some efficient consumption path. And the simplest thing is to assume a single consumption good C. I'm happy to talk about, and we will want to talk about, what happens if you don't have this single numerator, this single consumption good. The generalizations are possible, but they start to get a little messy and complicated, and they're not quite as strong as what you can get if you just plain assume a single consumption good. So here's some notation. There's an N vector. This is important. Well, there's just one consumption good. There are multiple capital stocks and multiple investments. So there's capital stock, capital K of T is a vector, an N vector, and net investments, which are just the derivative of capital with respect to time. Now, it doesn't matter whether this is a definition. Sometimes is this something that follows from something? Is it a definition? We don't care. This equation is always central, that investment, net investment is the change in net investment is the change in capital stocks. And then there's some production possibility set. I'm calling it A of K, and a combination of C of T and I of T is attainable, and there might be imperfections in this economy. We're just talking about attainable. Now, maybe they're physically attainable. They have to be physically attainable and somehow attainable consistent with the laws of this society. So it's producible if and only, this is a shorthand way of writing it, if and only CI belong to this attainable possibility set A of K. Now, here comes an important point that I'll emphasize again, and that all models emphasize in this area. Capital is so inclusive that it accounts for all sources of future growth. All the effects of time only operate through the capital stock in enlarging the production possibilities. That's a standard assumption, but I actually think that is the most critical assumption that's made throughout, that we have some notion of inclusive capital and net investment, and it's accounting for all of the growth. That's another direction to go in. If it's not accounting for all the growth, sometimes you can handle special cases of the residual. So I'm going to try to put this in the language of optimal growth theory. It could be put in other languages. I still think this is just about the simplest, though it's not that simple, way of expressing the solution that we are after. So the society is maximizing the present discounted value of present and future consumption with a discount rate R. So that's the objective function there in 2. Now, this is guaranteed when it's subject to the other constraints. This is guaranteed to produce a consumption trajectory along which the rate of return is R, because you're just maximizing this e to the minus R times C of 1 plus e to the minus 2R times C of 2 plus e to the minus 3. So it's like here's a production possibility set, here's profitability. If the profitability is just linear in the quantities, you will get a tangency solution no matter what this set looks like, this underlying production possibility. So again, the very maximand is going to guarantee an efficient trajectory along which the rate of return on capital, the rate of return on net investment is R. Okay, and then we've got a couple of other equations here. One of them stating that net investment is the change in capital stock, and there's an initial condition. We're stuck with the capital stock that we have. Okay, so one could take many routes from this, but I think that this one is as simple as any. They're all going to be kind of complicated. So here's a story. I'll go through this quickly, and I'll try to explain what it means. Let's define, this is just a definition, the maximized Hamiltonian expression H tilde of K and P. What it's doing is it's maximizing what you might call net national product with consumption as numeraire. So it's maximizing consumption plus some price of investment times investment. And here comes some duality conditions. The necessary and sufficient condition for a feasible trajectory to be optimal is that there exists an investment price trajectory, I'm calling it P star of T, satisfying for all T these conditions, that H tilde has to be actually equal to the consumption plus net investment, and a second set of differential equations that looks complicated. I don't have time to go into this, but basically, what's happening here is you're setting this up to look on the dual side as if it's a dynamic competitive equilibrium with a rate of return on consumption equal to this R. So any solution to this problem is going to look like a perfect foresight deterministic economy that is emerging over time. It's efficient, and the rate of return on consumption is R. So people, to actually explain all this in detail, it can be done. It's in the paper, what these things mean. They basically mean that, as I note in the last part here, any observer of this economy would swear they're witnessing the evolution of an economy with a perfect capital market in a dynamic, perfect foresight competitive equilibrium having rate of return R. Everything that's done in this area is some variant of this theme, that on the dual side, it looks as if we are in a competitive economy where the prices on the investment goods are representing rates of transformation among them. All right, so let me talk about complete accounting, comprehensive income, and wealth. Now, this is an important part. Again, it's usually an important part of almost any extension, of which there have been many. The accounting you might call perfectly complete here, because all sources of future growth have been attributed to comprehensive investments, I star, evaluated at their efficiency prices, with consumption as numeraire having a price of 1. So there's no other sources of growth. The passage of time itself doesn't cause growth. It only causes growth through the capital stock. So right away, our conceptualization of capital stock is that they should include everything that's influencing growth. So it would be human capital, it would be R&D, it would be all kinds of other things, so that by the time we're done listing these things, there's no role for time alone. So there's no exogenous technological change that's coming down from heaven and that is increasing the system independently. You can get away with not making an assumption. Again, you'll get weaker results, and there have to be special cases and so forth. All right, so that's it. This is complete. And we see that on the technology side, that this attainable possibility set is only a function of the capital stock at that time. So the T is entering through the capital stock at that time, and that's the only way time is entering, except for this maximand where we're maximizing present discounted consumption. Now, look, in this kind of economy, which any economist would swear is a competitive economy, a competitive dynamic economy, in this economy, and it's in this simple setup, it's characterized completely by saying that it's an efficient consumption trajectory along which the rate of return is R. That's synonymous with this maximization problem. So now in 8 here, we'll denote comprehensive income as measured by a national income statistician. That's complete income because all the capital stocks that cause growth are included. And what would a national income statistician stuck in this economy call net national product? He would call it the consumption times 1, which is its price, plus the inner product, the sum of the P star J's, I star J's Okay, so if we let loose, and we have this imaginary economy, we let loose a national income statistician, this is what every national income statistician in this context would agree is net national product. Now, what is wealth here? Here's where the simplicity of the setup allows us to do some pretty tight things. It's natural to define wealth as the present discounted value of future consumption. So that's how I'm going to define it. All other attempts at defining wealth seem, to my knowledge, to have problems. In particular, P of T times K of T, all right, just take the capital stock, put a price on them, call this wealth. That doesn't work. It has no desirable properties that we know of. It has no welfare implications. So we're not calling wealth the sum of the various capital stocks multiplied by the prices. We're not doing that. We're measuring wealth as being the present discounted value of future consumption. Now, next, what is income? Okay, this is used to be a kind of a hot topic at one point. Then interest was lost in it. Now interest has been revived, coming in this form: green accounting, comprehensive accounting. But once upon a time, this was the issue of what is income, what is its relation to wealth, was on the front burner. I mean, great economists thought about this and contributed to it. For Irving Fisher, now I'm paraphrasing him. He wrote several books that involved this set of issues, and he was a kind of an iconoclast. He made up his own terminology, and what he called wealth is not what I would call wealth, and what he called income is not what I would call. But basically, I think it's a fair reading to translate it in one sentence: is that Irving Fisher's measure of income was the return on wealth. So that's equation 10. So Fisher is working with the following, and these are operationally distinct concepts. In other words, what you would do in 10 is first measure wealth somehow or other, then multiply it here by that interest rate, and what you would call income is the return on that wealth. A second major concept of income was given by Eric Lindahl in the 1930s, I think. Income is consumption plus the net increase of wealth. So Lindahl's definition is 11, that income should be consumption plus the change in wealth that comes about. And now John Hicks had the definition that comes closest to the way we conceptualize things today, and it had a ring of sustainability about it. It was a very clever, indirect way of saying what is income. So this is my terminology, my paraphrase. Income is the sustainable equivalent consumption. It's not the actual consumption. It's the hypothetical sustainable equivalent consumption, I'll call it YH, satisfying this equation. So basically, this equation 12, basically, with starting at a time t, YH of t for x between t and infinity, YH of t is constant, right? So this is a hypothetical constant YH. It depends on t. It's a constant YH depending on t, such that by this criterion of maximizing present discounted utility, the present discounted utility that is actually attained at time t, the forward-looking present discounted value of the actual consumption, is equal to this hypothetical YH of t, which is constant. So you'd say that the person is indifferent between having a constant consumption YH and this actual stream of consumptions. Okay, so you can see this has within it some seeds of sustainability or a conceptual background of sustainability, Hicks understood full well that you couldn't just say you couldn't just say that sustainable equivalent consumption is today's consumption. He understood very well that this is a hypothetical concept that doesn't show up per se anywhere. This was his definition. All right, now I'm going to end pretty soon. With this setup, here's what we get. This is a strong result. All of these definitions, 1, 2, 3, 4, give the same answer. So that what the national income statistician is measuring as Y star of T, that will equal Fisher's measure of income. It will equal Lindahl's definition of income, and it equals Hicks's definition of income. So you're able to construct a very powerful framework here. Now, there's a lot of assumptions going into it, and as the day goes on, maybe we'll talk about weakening them. Here, too, now, if I jump to 15, I have the following that flows out of the theory, that the Hicks notion of income, hypothetical consumption that yields the same wealth or welfare as the C star of T, the difference between those two is given by this right-hand side of 15, which is P star of T times I star of T. So P star I star with these multiple capital goods is an indicator of the degree of sustainability here. So long as net investment is positive, comprehensive investment, we are able to, we will be in a future where we're better off than we are today, on average, by this same criterion of present discounted consumption. This has been generalized, but see, here's a good example of where when you generalize, you win something and you lose something. This is generalizable because this P star I star will continue to be, whether it's positive or zero or negative, will tend to be an indicator of the degree of sustainability. But when you go over to more complicated formulations, you lose the quantitative strength of 15. There's a lot been written in this area. You just can talk about whether it's positive sustainable equivalent or negative sustainable equivalent. You can't penetrate much further with a quantitative statement, typically. And 15 is analogous to a long line of independently developed of sustainability analysis, you might call it, beginning with the pioneering work of John Hartwick. So my concluding remarks, under strong assumptions, comprehensive income and wealth are two sides of the same coin. We really are never measuring wealth by P times K. We don't do that. When we measure it sort of the right way, it doesn't matter. And in this literature, I'm not sure how well understood this is. In this literature, well, never mind. Okay, so they're two sides of the same coin. They give very powerful results. It gives a framework. And I'll just make a mention. What is the weakest link in this chain? I'll give an opinion. It's not the single consumption good. This weakest link is not assuming a constant rate of return, because we can claim that that's some sort of a generalization of the world we live in. Although these are weak links, they need to be generalized, and they can be generalized. It's that the weakest link, which is shared by this approach and everything I think that follows in its path, is that the accounting is not complete. It omits technological progress, exogenous technology, but doesn't admit of that, except you can bring it through the back door in complicated kinds of ways under various special assumptions. But that's the issue. This framework here, along with the other frameworks that sort of grow out of it, as it were, all of them suffer from this issue that if you don't have complete accounting, you don't have strong relations. And so they're all going to struggle with this notion of what is comprehensive income and wealth when the accounting is incomplete. So that's what I would hold up as the biggest single weakness of this. Well, I'm about done. You can see there's very strong relationships out there. There is a framework. It's based on a bunch of assumptions. The strongest assumption, which is the incompleteness of accounting, is shared by almost all the models in this area, which need to assume complete accounting, but the complete accounting is not easily identified out there. However, this framework and other frameworks like it give us clues where to look for income, or where to look for investment or capital stocks that are not included in standard gross national product or even net national product. It's telling us we should deplete oil in some complicated way. It really is complicated because there's more oil reserves going up at the same time as old reserves are being run down. But we all know, for example, that we should be depleting natural capital in some sort of way. All right, that's enough.
Thank you, Marty, for a masterful exposition. I think I've been asked to explain and to critique. So I will give the compliments afterwards. Well, I've just done them, but it's from the spirit of love and excitement about it. So I come from, as a 21-year-old, I was brought into economics by James Mead, who was responsible for setting up the United Nations, League of Nations, and the whole SNA. And later on, I was mentored by Richard Stone, who actually got a Nobel Prize for national accounts before, when it was even dull then, in a sense. But the reason I'm mentioning that is that in my early days, I did work a lot on SNAs and systems of national accounts, even trying to be a bit comprehensive, but not as comprehensive as we try to be nowadays. But in a sense, accounts were a lot more agnostic than what Marty has just told us. They were just data, and you tried to organize them in a proper way. They were not just data, they were very important. I'm always embarrassed for my colleagues in the profession how little they seem to care about where the data come from. We remember that data could be, the GDP ratios, you get reliability indicators, they could be 20, 30% out of kilt, particularly if you're talking about acquisition of financial assets. So there's a lot of uncertainty there. But the main thing what Marty is doing here, he's actually, and this whole literature, is going from an agnostic approach to combining data with theory. I mean, let there not be any mistake about it. Marty has basically, got all these important relationships you got out on this last slide. It is an application of theory with extremely strong assumptions. So the strong assumptions is, as Marty has already said, they are complete markets, not only statically but also intertemporally. There also must be complete contingent markets, all the whole futures markets, the whole lot. And in every space there should be different prices in different spaces. It's very, very types of assumptions we know don't hold. Also, everybody must be rational, efficient, and hold perfect foresight. There must be no unexploited profit opportunities. In there, when Marty talked, and as I've used many times before as well, when you use your optimal control, you're basically ruling out all arbitrage opportunities. So that gives you, for example, in the field of natural resources, as a special case in the framework Marty has set up, will be something like a hoteling rule, which we know to be in violation of any data we know. I mean, there's one rule which doesn't hold, and that's the Hotelling rule. But it's part of this theory. So let's make that clear. What we're talking about, it's a normative theory. Everything is a hunky-dory theory. Everything is hunky-dory. All the theory is there. So it's neoclassical in every possible sense, in the sense that also all production sets rule out non-convexities. For those non-economists among you here, no increase in returns to scale, or it has to be of a special case, but otherwise it doesn't work. No threshold effects for climate people here, because if you go over a threshold, then the things become rapidly non-convex. So it's a beautiful theory, gets very strong results, we have very strong assumptions. Now, there's a whole line of literature, so the slide 7 was, in a sense, the nicest. There's the Higgsian income, which is the idea that income is basically that level of consumption that you can sustain forever. There's a debate whether it's consumption per capita or consumption. I would say probably consumption per capita, but we can talk about that. And there's another thing called the Fisherian income. Then you take, it is basically the return on your wealth, where your wealth is very broadly defined. That doesn't include just equity, shares, bonds, machines, whatever, all kinds of infrastructure. But it also introduces, it could be your oil in the ground, it could be the value of the natural environment, it could be the value of your trees and forest, it could be all the stuff that Dieter Helm has been valuing or trying to value in his committee. So it's this really broad measure. It's called W, but behind it is a whole world of stuff. The return on that is called Fisherian income. And then another one was called the Lindahl income, which people have used as well in the past, which is basically consumption plus the increase in that wealth. And the beauty of Marty's framework is that all these measures are the same in optimum, with all these markets clearing, everything perfectly competitive, perfect foresight, all the most wonderful. I'm not being rude because I've used these assumptions a lot, all these wonderful cloud cuckoo land assumptions, but then we get those results. So, and then let's be clear that if you make it a bit further, then you find that these 3 measures of income, which would just be the interest on this comprehensive measure of wealth, then as a special case of that, there is something called the Hardwick rule, which is basically assumes that you have some Rawlsian perspective on welfare, that you try to care most about the welfare of the poorest generation, if you want, and then you would actually say that genuine saving is 0, and I believe in your model genuine saving would be what Marty calls PI. So that means that that rule of the Hardwick rule means that any investment you do in machines or in capital or in roads or in transport or in infrastructure, so any depletion of natural assets you do, like deterioration of the environmental quality, taking all out of the ground, that must be reinvested again into, for example, physical capital, sovereign wealth, or whatever. That's what's called the Hardwick rule, and it flows naturally out of this beautiful framework. So the framework can be extended in many ways. I mean, one of the things which was not mentioned was the idea that, of course, many natural resources are renewable, or they're non-exhaustible. I think it's fair to say that that can be reasonably well accounted for. Kirk has done stellar work on that in the World Bank. But there are a few things I think which are important. So I was going to talk a bit about technical progress, but you mentioned it yourself, that is not a trivial issue. But another trivial issue is population growth. A non-trivial issue is population growth. I mean, the whole point that you have different generations. Because in a sense, here's kind of an infinitely lived individual. Now, in economics, we have a metaphor for that. We might have dynasties, and they're all connected by altruistic dynasties by operational intergenerational quest, which we know don't hold. But still, so we can make that work, but that's very special. So, but as soon as you allow for finitely lived individuals and non-operational bequests and overlapping generations, we're talking about capital market failures. And there may be many other capital market failures. And then the question is, how can we then go from this normative framework to a more positive framework? I think also underlying the framework Marty has talked about is the whole issue of ethics. Now, you know that better than anybody else, because if you ask Marty to talk about climate, he could give you a whole talk about, discounting. He could give you a whole talk about risk, a whole talk about intergenerational inequality aversion. Effectively, in this framework, you assume that intergenerational inequality aversion is 0. but you could allow for that. And there's the ethics part, which would have an influence here as well. I think also the idea, if you're talking about long-run projects, and there is risk there, as Marty has done in other work, you would probably have a discount rate which would be falling for longer-term projects. So if you're talking about climate projects, and if you're then looking for a discount rate, that would probably be a lot lower than those things in the future. Now, I don't know whether some of these things are just icing on the cake, just extensions to be done, or they're more fundamental. I have a sense that they're actually quite fundamental. Most important of all is that the framework that has been put forward, and which I've used a lot myself as well, but we should be frank also in connection with the future agenda, is that it basically abstracts from both political failures and market failures. It also assumes, for example, that all taxes that are hidden in the background are lump sum. And we know that when Mrs. Thatcher tried to do a poll tax, that there was a political hierarchy. So taxes are distorting in usually fact, and that will affect the results, that will break the results. I'm not sure whether it's a big potato or a small potato things. But we know that many markets are non-competitive. For example, when we talk about the environment or natural resources, say imagine that we have 200 gigatons of carbon to be burnt, then I could imagine in an oligopolistic framework that there may be, indeed, I was in Algeria only last week, and I explained to the Minister of Finance this 2 degrees problem. He said, oh, well, in that case, I will finish in half a minute. In that case, we should really deplete much more fastly. There's a race to burn the last ton of carbon. And in this kind of ferocious depletion or this ferocious extraction, which would violate our telling rule, is abstracted from this framework, but of course from an accounting point of view and from a welfare point of view may be very important. So these are these common pool problems leading to that. Another issue which you look when you want to use this in practice may be to look at international failures to cooperate, because if this was done in a multi-country world, we'd have to think of that at all. Having said all of that, I think it has been in beautiful 8 slides. It tells you all the theory you need to know, but it also tells you the strong assumptions you need to make, and that by implication tells us something about the future agenda. Thank you.
So we have about 7 minutes for discussion, and there's quite a lot to discuss there. And I think if it's okay, I might just chair these 7 minutes of discussion. And I'd like to kick off with one question to the floor. Actually, it's not just to Marty or to Rick, but as you said, very elegant, very nice presentation of the key assumptions. Rick's just said quite clearly those assumptions do not hold. Question: how problematic is this for this agenda? And in particular, think about GDP. Think about all of the assumptions that are required to build the edifice of GDP, and ask yourself the question, how many of them are the same as the assumptions that we require to build the wealth edifice? How many of them also, frankly, do not hold? And are we in any worse shape with wealth measures than we would be with GDP measures? And more generally, what can be done to improve the state of affairs that perhaps both of these measures are being built on theory that doesn't necessarily map on perfectly to the real world? And does it need to map on perfectly to the real world? So I'd invite comments on those issues in particular or anything else from the floor. Willem.
Thank you. Willem Buiten. What I find the weakness about the approach that we've just seen is that it uses wealth in a sense that is really only applicable at a global level, where everything is consolidated. And I would like the concept of wealth to be applicable to an individual, to a sector in the economy, to a country, as well as to the world. And that means once you get away from the world, financial wealth is a huge issue. And that fits rather awkwardly into this framework here. So I think let's work with something that can actually handle wealth in the way it's normally used as well. I mean, we can of course appropriate words any way we want to, but I think we shouldn't be too Alice in Wonderland about that. So I would like, therefore, to see define wealth not as the NPV of future consumption, but as the NPV of future income. By income, is in a market sense, is just net cash flows, and in a resource sense is future resource flows. For an individual, for instance, consumption need not be the purpose of wealth at all. The exercise of power may be the purpose, or transfers to others. And only with a very strange stretch of the imagination would transfers to others, say to buy influence, be described as consumption. So I'd like the concept to be relaxed a bit, so we can actually use wealth in all its normal applications, rather than just in this singular, what I would call a global environmental planner perspective.
Okay, I'm very happy for this to develop into a discussion between the room without me interfering, but let's just take a few other comments first, just to get the lines of the debate clear. Does anyone else want to contribute? Yeah, Marie.
Just an observation on how statistical offices, something they may think of. There's a fundamental difference between looking at GDP and measuring GDP, despite all of its conceptual issues, and wealth. And that is that GDP is basically an ex post exercise. You can look at what's happened, whereas wealth is really looking into the future. And sometimes people have said, well, it's about modeling, and national accountants do a lot of modeling, and that's particularly true for things like imputing the value of owner-occupied housing. But still, making those assumptions about the future that will have such vast impacts is something that many statistical offices, and particularly the countries from the World Bank, the countries that we mainly deal with, middle income or even low income countries, would be loath to take. So certainly we need to move in this direction, but we see this as a fundamentally different kind of challenge from measuring GDP.
Did you want to respond, Kirk, to that point, or add something?
Well, to wrap back to Bill, just to make a simple point that the book we're talking about is called National Wealth. So it's not to deny that personal wealth, household wealth, the wealth of firms doesn't matter. It's to say that when we define the progress, economic progress, as I was talking about earlier, for a country, we need to conceptualize national wealth. And to some extent, these things add up. There's ways to build these growth models where the
financial wealth.
Well, there's ways to extend the growth model to say, here is an accounting of net financial assets and the flows that go to and from the rest of the world. That still works fine when you're measuring national wealth. So just to make that point, that we're not ignoring what you're saying. There are standard models in the literature that cover that point. We typically don't go down to the household level in discussing this. And we do need to keep that focus. I think that it's about national wealth that we're talking, not to deny the importance of the household.
While you have the mic, or Marty, if you want to take it either way, I'd like someone to address Glimmery's point. So is there a fundamental difference here between ex post and ex ante, between GDP and wealth measures? I mean, Marty said, if we're thinking about measuring wealth, it has to be as the forward stream of future consumption. Willem said, let's make it the forward stream of future income. Either way, they're forward streams. An alternative is, which you explicitly said is not the right way to go, but which I know Kirk is working on, is to build up the capitals and the prices of the capitals, and perhaps Dieter might have something to say about that too, rather than be projecting and imagining futures 20 or 30 years out, build up the stocks of capital and the prices of them today. I can imagine a response to that is to say, how do you know the price of those stocks of capital, or the shadow price? Yeah. Can you avoid it? Yes, and maybe the answer is no.
So financial wealth, you say you would like it not to be in the form of some present discounted value. Yet the leading theory of what is financial wealth in the form of a stock in a particular company, well, that is the present discounted value of future dividends. So the most powerful theory we have, or maybe the only real theory we have, says that this wealth of a firm is going to be, or the stock market price is going to be the present discounted value of the dividends that they will pay. So I don't see a contradiction here. I don't see a contradiction, because when you go one step further, if you don't take financial wealth as just a given, if you go one step further and do the exercise, it should be equal to something like the expected present discounted value of dividend payments. Otherwise, and that's in the assumption that there's a competitive stock market. That doesn't have to be a competitive anything. As long as the stock market is competitive, it will force equality between the price of the shares and the expectation of present discounted dividends.
That's exactly what I said. Define it as a dividend, not consumption. Thank you.
All right. I'm having such a broad theory here that in principle it could apply to anything. That's a weakness, maybe. The other thing is that many of the things you were talking about, not all, can be redefined this way. Suppose a country is a small country and it faces international prices and it imports and exports. Okay, then the attainable possibility set for it incorporates these foreign possibilities of trading. That's not a serious analytical problem, as it were. There are variants that will give serious analytical, but the simplest ones are compatible with this framework.
Fantastic. I hope it is now 12 o'clock.